Most of the time, the returns are right smack dab in the middle, but there are also these so-called fat tails where things are down 30% in a week or in a couple of days, like what we've seen so far this week with Ethereum, down 27% in 72 hours. Same thing can happen on the upside, though, too. So those returns create those fat tails. Usually nothing happens. That's where the returns are smack dab in the middle, the distribution. But when things rip higher and you see a parabola form, that's the right tail. When things dump and assets like Ethereum are down 30% in 48 or 72 hours, that's the left tail. Volatility clusters like this. What do we have to do in order to be able to survive in a market that is so volatile? We have to size our positions inversely to volatility. So that means that the more volatile an asset becomes, the smaller our position sizing should be. So that's exactly what I've been doing. And thank goodness for that. Um, so also, automated monitoring really helps. You don't necessarily have to automate your position, your strategy, but you should write down your rules. You really should. I think that's a very important thing to do. Actual pen and paper, writing down what your rules are so that when there is a fat tail, you know exactly what to do. Let's move on through this. I don't want to spend time talking about stuff that I am not comfortable really talking about here. Okay, so there's a couple of different ways that we can calculate or measure volatility. One of the ways that I like to use is historical vol, and the reason I like this is because I can hop into TradingView and I can just bring up a chart of historical vol. So HV365, that's going to give me a chart of historical vol for BTC or for any asset that has enough data for it to be calculated. So that's one way. You can also, if I bring it back on over here to the presentation, you can use Garch, which I have been reading more and more about this. I'm not all that familiar with it. You can use like a realized volatility calculation. Maybe you could use something like an ATR, an average true range, to help you, set levels where you might want to be a buyer or a seller. Measuring volatility, I think the best tools to use are probably going to be HV, obviously implied vol, realized vol, your average true range indicators, and your Bollinger Bands. Those are all examples of volatility indicators. So just important to become a little bit more familiar with those.